Assalamualaikum warahmatullahi wabarakatuh. Shalom, Om Swastiastu, Namo Buddhaya. We are from Group 2 and in this session we will present about predictive and positive approach. Okay, before we start the material, I will introduce our group members. The first one is Velisa, Enjjelita, Sandi with 3 last ID number 038. Aulia, Puja, Dewanti with 3 last ID number 100. Rara Wiritanaya with the last 3 ID number 112, and then Syifa, Novia, Suryanti, Putri with 3 last ID number 147, and the last is Sandi, Bagas, Permana with 3 last ID number 403.
Okay guys, now I will explain about predictive approach. So the predictive approach is a method used to evaluate accounting measure or method based on their ability to accurately forecast future event. The key idea is that the best measure is the one that has the greatest predictive power. For example, if you're trying to predict whether a company might go bankrupt or how well it will perform in the future, and you have multiple accounting methods to choose from, the predictive approach will guide you to select the one that has historically been most accurate in predicting those outcomes. This approach is especially helpful when choosing between several accounting methods rather than relying only on theory or tradition. It uses real-world predictive performance as the basis for selection. Okay, now I will explain about purpose of predictive approach. So guys, here are 2 purposes of the predictive approach. The first is to identify the most effective accounting measurement method. So, the predictive approach aims to select the accounting method that has the highest ability to predict future economic events, such as economy earnings or financial distress. The method with the greatest predictive power is considered the most appropriate. The second is to provide an objective basis for evaluating alternative accounting methods. So this approach helps solve the challenge of comparing different accounting measurement alternatives by using predictive accuracy as a measurable and data-driven criterion, allowing for more rational and informed decision making.
Research based on the predictive approach focuses on 2 main streams. First is research that highlights the ability of accounting data to explain and predict economic events. In this case, accounting data such as income statement, balance sheet, and cash flow are analyzed to predict the likelihood of events such as bankruptcy, declining profit, or economic growth of the company. The second stream focuses on the ability of accounting data to explain and predict market reaction to information disclosure. That is, how the market, specifically stock prices, respond to financial information announced by companies. This reaction can be observed through movement in stock price or trading volume following earnings announcement, changes in accounting policies, or other important information disclosures. Both streams emphasize the importance of accounting information not only as a reporting tool, but also as a basis for strategic economic decisions. Several important economic events can be predicted using accounting data-based predictive approaches. One of the most common is bankruptcy or financial distress, which can be detected through analyzing a company's liquidity, solvency, as well as cash flow ratios. In addition, changes in stock prices or market reaction to information disclosures, such as income statement or dividend announcement, can also be predicted as markets tend to respond quickly to financial information. This approach is also used to project returns, taking into account profit trends, asset utilization efficiency, and growth prospects. Furthermore, bond ratings and risk premiums can also be estimated through an evaluation of the capital structure and the company's ability to service its debt. Finally, future earnings performance can be predicted by analyzing historical earnings patterns using methods such as time series analysis. By utilizing this approach, management, investors, and creditors can make more informed and data-driven decisions. Time series analysis is a method used to observe historical patterns in financial data, especially company profits over time. This approach helps in making future projections based on past data trends. One example is the Altman Z-score model, which uses 5 important financial ratios such as working capital, retained earnings, and market value of equity to predict a company's potential bankruptcy. There is also the Olson model, which adopts a logit approach and involves 9 variables to estimate the probability of a company's failure. Meanwhile, the Box-Jenkins model focuses more on statistical analysis and is used to forecast corporate earnings based on autoregressive and seasonal patterns. Interestingly, a company's quarterly earnings generally exhibit an autoregressive pattern, which means that future earning value are strongly influenced by previous values. In other words, the past becomes an important indicator of future financial conditions, and time series analysis becomes a very useful tool in supporting managerial and investment decisions.
Okay, the first material about the market model. The market model asserts the return of its security is linearly related to the market return. The market model has been used in the most studies evaluating the relation between market return and accounting return. And to estimate the parameters alpha and beta, research has generally relied on the ordinary least squares approach, which is assumed that the parameters are consistent during the event period. Okay, the next is about the beta estimation. Is the various corrections have been proposed to account for the potential problem of error or systematic risk and estimating beta. The generalized Colvilleum correction provide the following estimator. And for all friends, you can see in the picture where b plus 1 is BO, is b minus 1 is leading contemporaneous and large beta, and a p first is first order serial correlation of the index. Okay, the next material is about the beta estimation. Is about the ERT and RFT is a ERMT is minus RFT times B, where ERIT is the expected return of security in period T, RFT is the return of the regional asset in period T, IRMT is the expected return of the market portfolio in period T. RMT is the covariance between REIT and RMT. S2 RMT is the variance of the return on the market portfolio. P equal is SS is R2 is ITR9 RMT is risk coefficient. Okay, next is about the residue earning model. In the dividend discount model or DDM, the value of the firm is the present value of the future dividend stream to equity holders. And all friends can see in the picture where VT is the equity value of the firm at the time T, DT is dividend at time all capital flow of equity holder net of contribution, R is cost of equity capital, and E the expectation of operator. Okay, the last is about the residue earning model. Is substituting accounting variable into the DDM Olson and Vetlam developed, and the following expression relating firm value to accounting value. And all friends can see in the picture. And the value of the firm or VT at the time T is the sum of the net book value or PT plus and the discounted expected future abnormal earning XIT.
Okay, I will explain about model of the relationship between earning and returns. The first one is basic initial equation. The initial equation shows the relationship between stock price and book value per share. Stock price of firm G at time T equals book value per share of firm G at time T plus error component or other unexplained factors. The second one is change in stock price and earning. To analyze the change or return over time, we take the first differences of equation. The first one is resulting in the change in stock price of firm G at time T equals change in book value per share of firm G at time T plus error component or other unexplained factor. Next, the change in book value per share of firm G at time T can be expressed as the change in book value per share of firm G at time T equals accounting earning of firm G over the period from T minus 1 to T minus dividend paid during that period. Is linking earning to returns. To calculate stock return, substitute equation 3 into 2, then divide by the beginning of period stock price. Return of firm G's stock during period T equals accounting earning of firm G over the period from T minus 1 to T divided by stock price at the beginning of the period plus error component or other unexplained factor. Alternatively, it can also be expressed as return on firm G stock during period equals change in stock price from T minus 1 to T plus dividend divided by stock price at the beginning of the period. From me is evaluation of market market-based research in accounting. Market-based research in accounting aims to understand how accounting information affect market behavior such as stock price. The available evidence from this research can be grouped into four main categories. The first one is information content studies. These studies examine whether financial statements such as earning reports or dividend announcement contain useful information for investors and whether that information affects stock price. The second one is differences in discretionary accounting techniques. This look at how differences in accounting policies chosen by management, such as depreciation method, inventory valuation, influence how the market perceives the company. The third one is consequence of regulation. Analyze how new financial reporting rules or policies, such as new accounting standard, impact stock price or other market reaction. And the last is impact on related disciplines. Explain how findings from market-based accounting research contribute to or influence other fields such as finance, economic, or management.
Okay, so in here I will explain about the positive approach. So the positive approach in accounting is an inductive and anthropological approach where the main focus is on existing accounting practices and management attitudes toward these practices. This approach doesn't start from ideal norms or rules, but from the reality on the ground. Proponents of this approach believe that accounting techniques can be verified and justified based on the result of testing their use in real practice. In this case, management has a central role in determining the accounting techniques to be applied. The main objective of the positive approach is to increase the reliability of predictions through the presentation of accounting data that has been adjusted to trends that are considered normal by management. In addition, this approach also aims to reduce uncertainty due to fluctuations in earnings figures and lower systematic rates, specifically by lowering the covariance between company returns and general market returns.
That's all from us. Thank you for watching this video. And the last, wassalamualaikum warahmatullahi wabarakatuh.